Hi, I'm James Nelson, partner at Massey Knakal Realty Services, and I'm happy to bring you the Nelson Report's June podcast. In my last blog posting, I talked about why we have not seen an increase in the amount of listings this year. Last year, my company projected that we were going to see a 30% increase in the number of listings this year, but that has yet to happen. Back in 2007, our company had a total of 750 exclusive listings. It should be no shock that that number dropped drastically in 2009 to 500. Back then, a lot of owners could not afford to get out from under. Long-term owners did not want to sell in a distressed market, and as a result, we saw a lot of our listings fall by the wayside. In its place, instead of selling properties, we ended up selling a lot of loans as a result of these broken condos and a lot of land deals that were still taking place. Now, since 2009, we've seen a big uptick in the number of sales. In fact, in 2011, the total dollar amount quadrupled for New York City property sales over 2009, and the number of sales went up 30%, showing that there's also been larger sales which have taken place. So the obvious question is, if we've seen a big boost in the amount of sales, why has our inventory flatlined? Our company has yet to increase our amount of listing inventory above and beyond 500 listings. I think a big reason is that listings today are staying on the market for a lot less time. In 2009, the tables turned. It was a buyer's market. Finally, buyers saw that they could take their time negotiating a contract in their favor. It took a long time to get financing on board, and as a result, things lingered on for months and months. Today, our sales are happening at an unbelievable pace. In one example, we sold 22 East 13th Street from start to finish in 49 days. We had dozens of tours, we had 21 final offers, and our ultimate buyer contract closed. My team alone this year has closed 5 properties where we brought them to market and signed a contract within 30 days. Our typical marketing process goes on 6 to 8 weeks, and then it can take another 2 or 3 weeks to negotiate and sign a contract. So a year or two ago, it typically took us 2 or 3 months to get a property into contract. So this is a big shift. Today, the buyers are coming cash in hand. A lot of the buyers are all equity. They're looking to park their money in hard assets, and I think that's definitely moving things along. So the question is, where is this boost in listing inventory going to come from? And why do we think there was going to be 30% more listings this year? Well, we thought the anticipated capital gains increase was going to be a big part of this. The Bush tax cuts are set to expire next year, meaning that the federal capital gains rate is going to go from 15 to 20%. In addition, there was a healthcare surcharge that was going to tack on an additional 3.8%. So if you bring that up to a total of 23.8%, that makes a big difference. If a seller was going to take a $10 million profit and sell next year, and these tax increases go into effect, that means $800,000 more in taxes. So the question is, why wouldn't they sell this year as opposed to next year? I think the biggest objection we get is, where am I going to put the money? Years back, owners were willing to diversify and take money out of real estate and put it in the stock market. But right now, with all the uncertainty in Europe, no one wants to put their money in the stock market. Treasuries are paying practically nothing. So a lot of owners are saying, well, even if my asset is underperforming, it's better to keep it in a hard asset where I know what I have. The other source for listings are discretionary sellers, those who look to sell and buy into other properties. The challenge here is, if owners of properties can't find other listings to exchange into, it creates a vicious cycle. And so for this reason, we've also seen our listings stay flat. Unfortunately, I don't think I have great news for you moving forward, because if the capital gains increases do go into effect next year, this is going to put a lot of pressure for owners not to sell unless if they can do a 1031 exchange. The only bright spot here is that triple net lease properties around the U.S. should see a big bounce in value, as once again owners will look to exchange. However, this is not going to be much help to New York City, because it's rare that we get a single tenant triple net lease asset, as most of our properties are either multi-tenanted or mixed use. So that's all I have for you this month. Thanks again, and look forward to speaking to you soon.